This is Robert Kraft, and I'm your host on SNN.Network. And joining me right now is Jeff Eberwein. He is the chairman of Digirad. It's a publicly traded company. The symbol is DRAD on Nasdaq. Jeff, thank you for joining me today. How are you doing?
I'm doing well. Thanks for having me.
Great to have you on. So I'd like to start our interview today with a quick overview, and then also understanding a bit better how the company's business has evolved in the last year to a diversified holding company with several business divisions.
Sure. No, I appreciate the question and the time today. A lot of different thoughts there. We started off life as a healthcare company. We're in the medical imaging business, and we've always been a small public company. We have tax loss carry forwards, and I started out as an investor. I've invested in a lot of microcap companies. And to kind of jump to the chase, I've come to the conclusion that a lot of public microcaps probably shouldn't exist as public companies. And so we could eventually be a home for some of them where it's a good fit with the structure that we're building. So we made the decision to convert our structure into being a multi-industry holding company. We did an acquisition last year of a building and construction company called ATRM that closed in September. And since that time, we've been working on turning around that business, growing that business, and we recently announced some significant large contracts in that business. So we are starting to see some success in our strategy of growing things after we acquire them.
And just to quickly follow up on that, you've made this transition now to this diversified holding company. What's some of your criteria when you're looking at a potential acquisition?
Sure. So we would like a business that we can understand, often that would come with its own management team. So when I started investing in microcaps and I started serving on some of the board of directors of some of these companies, there were two things that really hit me. One was how much money they have to spend on corporate overhead and public company costs. So that could be an opportunity to find another public company, maybe even a private company that would fit well with our structure, where it's just a lot more cost efficient to be part of our structure. So that's one thing. And second is another thing that really struck me is how little time the management team has to spend on running the business. Often they have to spend a tremendous amount of time with the auditors, with the attorneys, with investors, and their Jacks and Jills of all trades. They get involved in IR issues, IT issues, HR issues.
Talking to me.
And so then these are the most, hopefully, talented people in the company. And ideally, you really want them focused 100% on running the business, growing the business, looking for acquisition opportunities, meeting with clients, meeting with employees, looking at new business opportunities. And when I started serving on microcap boards, I was surprised at how little time the typical microcap management team has to spend on actually running the business and growing the business. And so where it could be a good fit is we've built a corporate team, a corporate center, and the idea is that this team in this center will handle all of the corporate functions. So get the audit done, get the capital raising done, get all the SEC filings done, deal with capital markets, help with finance and strategy issues. But when it comes to operations, have businesses that are good businesses where the management teams are freed up to really focus on operating the business. And it's hard to quantify the benefit of that, but we think it's very real. So we like to find businesses that fit well with that structure. Businesses that we understand. We prefer something with existing revenues, earnings, cash flow. Doesn't have to have assets. It could be a services business, but we want something that's already a business that's up and running. We're not inclined to invest in pre-revenue type of opportunities or venture capital type of opportunities. That's just not our skill set.
So you actually alluded to this already in the first two answers there, and that's your
Mm-hmm.
background. You
Mm-hmm.
investor in microcap companies.
Right.
I should have you on my podcast talking about your investing strategy, because it sounds like you've had some experience there.
Right. Well, I have always been a value investor. I like to think of myself as a hands-on value investor. So I worked on Wall Street for a number of years and then decided to start my own investment firm. And the whole value investing thesis is that company ABC is worth $10, but it's only trading at 5, and so it's cheap relative to its intrinsic value. So I'm going to buy it at 5, and someday other people will see what I see, and it'll eventually be 10 because that's what it's really worth. And that is a great way to start as an investor, and it's worked for a long period of time. But in microcap land, I've learned that things can stay cheap. And then I would say when I was younger, I was probably a little more arrogant about um, thinking I'd found some hidden gem, and I'm so clever that I found this thing and it's worth 10, and I see all these things that other people don't see. And a lot of times something's trading at 5 for good reasons. It could be that the management's not doing a good job, or the board is not doing a good job, or they have costs that are too high. And so the market can actually be pretty smart and pretty efficient and say, yeah, there are some scenarios where it's worth 10, but there's all these discounts because they haven't been executing well, or they're just too small, subscale. And so I became, so I've always been a value investor, but I became even more excited about the idea of investing, getting hands-on the way a private equity firm would do, and then doing whatever it took to close that value gap between, like what I was talking about, something that's worth 10, but only trading at 5. So it's a little bit more of an active approach than a passive approach, and that led me to joining Digrad's board and investing in it. And we've been embarking on this new strategy, and some others as well. But I would boil it all back down to being a hands-on value investor.
Got it. All right, we're gonna have to talk again at some point, because I want
Okay.
I'd love to hear more about your investing strategy.
Sure.
But getting back to the job at hand that we have here,
Mm-hmm.
with Digirad. So what would you say makes the company unique and different to your peers? And another way in which I'm looking for is trying to understand what the company's core value proposition is compared to other diversified holding companies out there.
Sure. And when I started out investing, I used to be skeptical of holding companies or conglomerates. And a lot of people, including me, thought that it was a recipe for trading at a discount and having a management team that's spread too thin.
Well,
And I definitely,
everyone has the next Berkshire, of course.
well, there's only one.
Yeah, exactly.
There's only one of those. They're in a league. They're in a league all their own. But when we looked into it and researched it, it's actually hard to find the conglomerate discount in the market. You can find some conglomerates that trade at a discount, but you can find others that trade at a premium. But I think that analysis and that thesis is particularly relevant for bigger companies. So once a company is above, say, $1 billion in market cap, it probably does make sense to be a pure play, because they're big enough to stretch all those fixed costs, the corporate costs, the public company costs, over a decent size of business. They have critical mass. But if you take a microcap company, so a company that's below 100 million in market cap or below 100 million in revenue, they have to spend a tremendous percentage of their revenue on corporate costs and public company costs. And so the idea of putting 3 or 4 or 5 of them together and spreading those corporate costs and public company costs across 5 companies instead of 1 company is really intriguing to us. And we also think If executed well, the combined company should have a lower cost of capital and be able to generate a higher return on the capital that it invests, because it's got 5 different areas to deploy them rather than just one area.
Got it. So I want to get into one of the news releases the company announced earlier this year, and it was
Hmm.
regarding the company's key growth and value enhancement initiatives. Can you
Hmm.
describe a little bit as to what they are, and then how the company has executed towards those initiatives thus far?
Sure. So I talked about the history of Digirad being a healthcare imaging company. It's a really good business. It's a mature business. It generates really good cash flow. It's a really solid foundation for our company, and it's really the cash flow engine and the stable base of our company. But it's not a growth market that we're in. If you think about the number of people getting scans in a given year, whether it's an MRI scan or we have a machine that does heart scans in doctors' offices so you don't have to go to the hospital. Um, that's a pretty mature business, a pretty mature market. So that's our cash flow machine. And then this building and construction business that we acquired is our growth engine. And so the two businesses actually fit really well together, because one has cash flow, not much growth. The other one has tremendous growth opportunities, but needs a little bit of capital in order to grow it. So we have raised capital. It's now um, very well capitalized. Last year, that building and construction business did about 30 million in revenue, and we have a plan to double that by next year sometime. And we have added to the sales force, ramping up output at our factories, and growing our business, growing the market, and we've signed some new contracts recently. So it's kind of combining uh, the growth and value concepts to a degree.
So then, from what you can tell us, what would you say are the company's mid and longer term growth drivers now moving forward?
Sure. So in the healthcare business, we're focused on higher margin um, parts of our business, services. We have all these relationships with doctors' offices, probably 500 doctors' offices in the country. We have relationships with a lot of hospitals, and so we're exploring ways to add more services to those customers. Um, so we're trying to improve margins and improve growth in that business where we can, without investing uh, tons of new capital. So that business is, like I mentioned earlier, a solid business, a steady Eddie business, and we do think we can grow it over time, and it generates really good cash flow. It's not cyclical, it's not economically sensitive. Nothing's immune from the impact of COVID-19, um, but and then the growth side is really coming from this building and construction business that we bought. We think we have the most capacity of any builder in the Northeast. So we have factories in Maine, for example, and some of our recent contracts. We got a contract to build a bunch of townhomes for an Army base. We got another contract to build. Refurbish a building in the suburbs of Boston that's going to partly be used for veterans housing. So there's a lot of interesting projects out there like that. We have a really great product for workforce housing, which is a really big issue in a lot of cities where the cost of living has gone up. It's difficult for the workers to afford to live close to where they work. So they either have very long commutes or subpar living conditions. And we have a really great product that we've designed with some of our customers that we're building on Cape Cod and in the outskirts of Boston. that's a really good solution to that problem.
So with that, where can my audience go and find everything they need to know about Digirad?
Well, they can go to our website, which is www.digirad.com. We have investor presentations, news releases. We've been talking about this conversion to being a multi-industry holding company for some time. And we just made this pretty significant acquisition in September. And so right now we've been very internally focused on improving that business, turning around that business, growing that business. But we think at some point soon, with continued good execution there, we will start to look for new opportunities. And they're really in two categories. One is bolt-on acquisition opportunities, where one of our existing businesses, whether it's healthcare or the building and construction business, we also have a real estate and investments subsidiary. So a business that's complementary to what we already have, where we can bolt it on to our existing operations, is something that we'd be interested in, something we would look at. But we would also start to look for new legs to the stool. And there could be some interesting investments for us out there. Public companies could be a fit, or private companies could be a fit, but predominantly we think we're going to look at other publicly traded microcaps where we can look at the company and honestly say it's more valuable inside of the holdco structure that we've built. And I'd also point people to the preferred stock that we created and got listed on Nasdaq last year. The ticker symbol is very similar to our equity ticker symbol, DRAD, but this has a P at the end, so the ticker symbol is DRADP. And we created this preferred stock to use to buy the building and construction business. And we could do that again in the future if there's a private company or a public company that is interested in that preferred stock. We could actually use that as a tool in the toolkit to grow the company over time.
Well, Jeff, with that, thank you so much for taking the time to do the interview with me. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
My pleasure. Thank you.